Today, I'm going to talk about DSCR loans. This loan program allows you to buy an investment property without having to show any income. Pay stubs, no tax returns, no job. Don't even have to put any work info on your application. And this program has no limit to how many investment properties you could own or buy. I'm going to show you exactly how these loans work and how you could start utilizing them as well. Hi, I'm Justin Brown, a real estate investor, personal finance junkie, and mortgage broker. Make sure to hit that like and subscribe button so you don't miss out on any of my weekly videos on real estate investing and personal finance. All right, so DSCR loans, it stands for Debt Service Coverage Ratio. This is pretty much the loan program that commercial lenders have been using for years on commercial properties. But over the last few years, this product has become available for residential properties and it's growing exponentially in popularity, and for good reason. First, it's important to understand the difference between what's considered residential and what's considered a commercial property. A residential property is any residential home that is between 1 and 4 units, and anything that's 5 units or more is going to be considered a commercial property. Now, there's lots of lenders that'll do DSCR loans exactly how I'm going to describe today, up to 8 units. Once you cross that 8-unit mark, you are going to need to go directly to a commercial lender at that point, which is still going to have this DSCR component I'm going to cover, but there's definitely some more hoops and qualifications you're going to have to go through above and beyond that commercial lenders will look at, but I'll get into that in another video. For now, any property that's between 1 and 4 units, residential, or 5 to 8 units, commercial, here's how the DSCR loans work. So 1, you have the debt service, the DS part of the DSCR. Debt service just means what is the debt that needs to be serviced each month. The mortgage payment, including taxes and insurance. So once you know how much the mortgage payment is, the PITI, principal, interest, taxes, and insurance, the full payment, then you know what the debt that needs to be serviced is. And then 2, you have coverage ratio, meaning what percentage of that debt, mortgage payment, to be covered by the rents that are coming in. So for instance, a lot of lenders allow what's called a 1-to-1 ratio. That just means it needs to be equal, 1-to-1. The rent payments need to match at least what the full mortgage payment is, or be more. And then some lenders might require a 1.25 coverage ratio, that the rents need to be 125% of the mortgage payment. So if the mortgage payment, the full payment, again, with taxes and insurance, is $1,000 a month, then the rents would need to be at least $1,250 a month, 125% of that $1,000 a month. So the coverage ratio is basically what percentage of that mortgage payment needs to be covered by the rents. So now something a lot of people don't know is some lenders will even allow what's called a negative DSCR. That means the rents could actually be less than what the mortgage payment is. You heard me right, it could be negative. You might ask, like, why would any lender or person in their right mind want a property that's negative each month? Well, here's why. See, Airbnbs have been growing in popularity the last few years. And with DSCR loans, they do not take Airbnb or short-term rental income into account, only long-term rents. And you have a lot of people buying in markets where the short-term rents are drastically more than what the long-term rents could be. So in a lot of markets, a property might not make sense as a long-term rental with the price that they're paying. But since these DSCR programs don't take short-term rents into account, some lenders have done is loosened up their guidelines to allow a negative DSCR. But usually the max negative that they'll allow is what's called a 0.75 ratio, meaning the long-term market rents in that area need to be at least 75% of the mortgage payment. Honestly, my 2 cents, I would never buy a short-term rental property that I couldn't convert into a long-term rental property and have it at least break even. I would be very careful buying a short-term rental, or it's in a market that the long-term rents wouldn't even cover the mortgage payment, because if the market shifts or occupancy rates drop dramatically, you're not going to have a safety net and you're going to be stuck bleeding every month. So just keep that in mind if you're looking at a property that you're going to need to go negative DSCR on. Now, there's definitely some other types of deals that negative DSCR will work on also. So just know that some lenders offer that flexibility of the negative DSCR. Now, geographically, there aren't any restrictions that I've ever seen on anywhere in the US that this program's not allowed or offered. I've posted some reels on Instagram and TikTok and stuff, and people have commented, oh, they don't have that in this state or this county or this area. I've never seen that. Every lender I work with, all the different ones that I do business with, it looks like there's no geographic restrictions on this that I've seen at all. Now, the down payment most lenders will require on this program is 20% down. But get this, on a full doc conventional loan where they're going to want your tax returns, your work history, your firstborn, your blood, everything, those harder loans require 25% down. So that's just another reason why these loans are so popular. They're easier to qualify for and they require less money down. Now, a lot of lenders will require that you have some real estate experience, whether you own a primary residence or you own another rental property. But if you don't, that's not the end of the road. Some lenders are still okay if you have no experience. They might require a little bit more money down though, so keep that in mind. I've seen lots of lenders work around this, so don't get hung up on that if the first few lenders you talk to can't make it work. be afraid to check around or contact me. Last, typically the FICO score requirement I've seen is around minimum 680 if you're going to do at least 20% down. If you're going to do 25 to 30% down or more, I've seen them go as low as 620 or even 580. But the lower your FICO score, the more money they are going to want down. The common threshold I see for 20% down hovers around the 680 mark. So the next time you come across a property that you're interested in and you want to see if this loan will work, the first thing I would do is I would ask that agent what the market rents are on that property, or look them up yourself on a site like rentometer.com. Then once you know what the rents are, get a payment estimate from your lender and ask your lender what their ratio requirement is. So then you can see if it's going to fit. And if it does, and you have at least 20% down along with the 680 FICO score, you should be good to go. Feel free to reach out to me if you have any questions, drop a comment below, and don't forget to hit that like and subscribe button to get some more tips on your real estate and personal finance journey.